Good morning. I want to begin this conversation by introducing my guest now to talk about the Federal Reserve interest rate decision, which will be on Wednesday. So I'm joined by Anthony Cheung from Amplify Live to discuss this upcoming Federal Reserve monetary policy announcement. Welcome, Anthony.
Hey, Sam. How's it going?
Yeah, very good. Thank you. How are you?
Yeah, good. Raring to go.
Good. So first of all, Anthony, I'm just going to ask you what is expected from the Federal Reserve in terms of their interest rate and their asset purchases at this meeting.
Yeah, so on that regard, not a great deal. They're definitely not going to be hiking rates. That's not going to happen for another few years yet at best. And we're not expecting any change as well in terms of their regular monthly bond buying. So at the moment, $120 billion worth. Split between Treasuries, 80 billion and 40 billion in MBS. So that will remain unresolved. The focal point, not so much is about any definitive policy change this time around on Wednesday.
Okay, so no policy change from the Fed this time. However, they are releasing their dot plots, their summary of economic projections. What do you think we could see change there?
Yeah, so that's a point that could be a little bit more interesting. So just for kind of overview sake, so there are 8 meetings that the Fed have per year, every alternate one, so 4 times a year, March, June, Sep, we get these projections of what they think about where's unemployment going to be, where's growth, where's inflation. The important one is where is interest rates going to be over time. And so when they have the meetings, all these members vote and we can get an idea of the median kind of dot plot, as it's called. And what is the trajectory of interest rates then in the future? Now, at the moment, the current Fed communication is that they're not going to look to hike interest rates until after 2023. But given the successful now in America, touch wood, good situation of the vaccine rollout, we've now had the stimulus be in action by Congress. Those stimulus checks hit at the weekend. And so we've still got the infrastructure project to come from Biden. So the economy's heating up. This is what's led to this yield movement. And people have brought in the money markets the view about when the next future rate hike could become. But what the markets are expecting is that might not even come until 2023. The Fed communication is a different matter. And the likelihood is here that the dot plot on the median dot plots for rates, importantly, will remain unaltered from December. That, though, could be one of the tangible things that could cause a market reaction on Wednesday, is about, well, how many of these dots are centralized in a way of which shows then that perhaps some of those members have moved to a rate hike in 2023 in itself. Will be a key thing to look out for.
Great. Well, thank you very much. And so if there's not too much of a change this time around, do you think maybe in the future that could be something that the Federal Reserve might change going forward in maybe the June meeting?
Yeah, I mean, absolutely. I think you're absolutely right. I think at the moment, the markets have had this kind of overwhelming expectation that the Fed has got to react to the recent yield moves that we've seen, which has reverberated across different global assets. It's put equities under pressure for a period, seen rotation out of growth into value, so out of tech, for example, and so on and so forth. So timings wise, I think that June definitely carries much more kind of context as for our ability for the Fed, that is, to see then what the future looks like at that point in time. As I said, we should be fully, almost without any hurdles unforeseen being encountered, it should be reopened in the US. Biden's had a very ambitious target of getting the entire population inoculated 2 months earlier than we previously thought. So now he's looking at May. So come June, we'll have to have an idea then what is the status quo, and Q2, we're expecting quite a big uplift then in GDP performance in the US, and subsequently then this yield movement will start to get more and more in focus. So yeah, long story short, is he going to comment this time round on yields? I don't think that the Fed will, or do they need to, as much as the markets might want Powell to, but that in itself might constitute a type of reaction. It really depends how yields move between now and the meeting, which is about 48 hours away from when we're having this conversation.
Great. Well, thank you very much for that, Anthony. And do you think there's anything else we should be looking out for from this meeting from the Federal Reserve? You obviously mentioned the yields there.
Yeah, I mean, it really is a yield focus for sure. There's not a great deal else I think that he'll comment on. I mean, As you know, the Powell and the Federal Reserve aren't there to really talk too much on the political side of things. With that, I'd say the stimulus is in now, so it's been signed off. If anything, it does, to a certain degree, put more expectation to support this rising yield narrative. But I think ultimately, if you can have an economy that's performing and a kind of based on the fact that equities and yields can in fact move up together, historically that has been the case. I think the market's got over some of that shock and awe of yield breakout that we had with the 10-year yield moving to over 1-year highs and the break-even 5-year inflation rate, the highest since 2008. I think people have steadied a little bit because the Powell has stood off, counteracting that and explicitly trying to counteract the rising yields. And I've got a comment here that he said back on the 4th of March, which I think he will recycle this time round, which is it would take substantial time to achieve the Fed's goal of full employment and 2% sustained inflation. And I think that's exactly what you'll hear. As I said, though, will some people be disappointed then? And might that then, as a result, lead to further yield movement, which could subsequently lead to other moves, dollar strength, perhaps this kind of mildly hawkish reaction, possibly? Does it actually mean something beyond then that short-term knee-jerk reaction? I don't actually think so.
That's great. Thank you very much, Anthony. And obviously, the Fed's not the only central bank in town this week. We've also got the Bank of England and the Bank of Japan. Do you think either of those will say anything too exciting this week?
Yeah, Bank of England, I think, is probably the most dull out of the three. From our expectation, really not looking for a great deal. Bailey made a few comments recently. I think he even spoke again this morning. But definitely no policy changes on the horizon there. Interestingly, we've seen a radical shift from just several months ago talking about a real prospect of negative rates in the UK to now the conversation is about rate hikes. At what point in the future they might come. I mean, it could be a few years away still, but the shift is based on, again, the COVID-19 is the main definitive economic kind of force that's driving markets as a macro theme. And the UK, obviously being one of those countries that has had a very successful deployment of that program, has meant that that negative rate talk has gone. I don't think we're going to see it. Not now. Not going to say ever, because I know I get myself in trouble for saying that. But I think the prospect of that happening as a pandemic response, that moment has passed. I don't think it's necessary now. So rates and Bank of England's strategy will be on hold for the foreseeable future. As the BoJ is concerned, that's a little bit more interesting. They've had a kind of a policy review ongoing, which we're set to hear results from on Thursday night going into Friday. And that could be interesting as to, well, what are they going to do about their ETF purchases, yield curve control? Today shows some degree of more tolerance around flexibility of that. Kuroda has suggested perhaps not, but the markets are quite keen to see then, with a variety of different policy options that they have, where are their heads at? So probably the BoJ is a little bit more interesting and potential then for subsequent reaction. But I really do not see the BoJ filtering out and moving other global assets. It's a Japanese story that's very much more about the yen potential movement. Even then, I see that as moderate to little, if any. It's much more about the Fed. And then the Bank of England, I think, will be, I think you can have a prolonged lunch and just come back and not too much to panic about there, I would think.
Sounds good to me. Sounds good to me. All right, well, that's great. Thank you very much for that, Anthony. And finally, where can we find some more information about you and Amplify Live?
Yeah, sure. So every morning I do a kind of global macro, very much a fundamental based briefing very early in the morning. We share with our traders, but it goes up publicly on our Amplify Trading YouTube channel. If you just search Amplify Trading on YouTube, you'll see it. So feel free to catch that there. 10 a.m. London time it goes up. And then on Twitter, just search my name, my handle, AWM Cheung. And then we also have a podcast that me and the head of trading put out every Friday, reviewing all of the major things from that week, like a 20-minute catch up. And that's called The Market Watch. So if you just search Market Watch Amplify Live on Apple, Spotify, you'll be able to find it.
Great. Well, thank you very much for that, Anthony. It's great to speak to you.
You're welcome. Thanks, Sam.
Cheers.